I'm Brad Vale. I manage Johnson & Johnson Development Corporation, which is J&J's venture investing operation. We have 9 people around the world doing venture investing for J&J. About half of them are medical device folks, half of them are pharm and biotech, and then we all share responsibility on what we call either white space or new growth platforms, and we also support our consumer business. So we, on average, probably do about 8 to 10 new investments in a year, 15 or 20 follow-on investments. Most of those are direct investments. We have done some investments in venture funds and incubators. We believe the best growth for ourselves is to be close to actual deals and not become a fund-of-fund type investor. We've always gone fairly early. We've also gotten closer to a number of incubators and accelerators. So we're, in our medical device investing, very open-minded about going in at the concept phase, knowing it's high risk, both that the idea might fail and that the direction of the deal would change considerably. It may turn into something we're less interested in, but we've been at this since 1973. I think there are different eras. The original group was very financially oriented, very Series B and beyond collaboration oriented. Since then, we've stepped back and really tried to behave more like a conventional med tech investor and have a mix across our portfolio of seed stage and incubator, accelerator collaborations, all the way up to some very large later stage investments. I think another thing we're doing a little bit differently is a little bit more of a portfolio approach. So rather, I think early on in a lot of strategic investor lives, they'll pick a couple of higher risk, further out things to explore. And I think in general, when you pick one and see how it goes, it often doesn't go very well. For us, we've tried to balance some higher risk, some closer to market activities, trying to get deals that complement each other and then also complement our internal strategies. So J&J is a highly diversified healthcare company, so we have medical device, pharm and biotech, consumer products, diagnostic products, and even some exploratory investments in new growth platform areas. And we've found that if we can get a complementarity between what's going on in a particular area in J&J, what's going on, 2 deals that might balance the risk out there in the field, that portfolio view, if it complements each other, it helps us get where we want to get to in a better way. And then just for us, internally managing our portfolios, it's easy to sign up for an investment. In the last decade especially, those commitments turn out to be very long commitments over many rounds of financing, so we want to make sure we get that right up front. One thing that's a newer concept for us strategics, and we've seen this with some private funds and some other strategic funds, is the idea of value-add investing, meaning we ought to be able to bring insights to the deals, whether it's regulatory issues, clinical trial design, maybe even preclinical models in some cases. One of the most popular inputs we can bring is in the reimbursement arena. So I think we've tried to step up and focus more on the success of the entity. We describe it as creating options. So we do equity investments to create options for J&J. That may be information rights. That may be as simple as a material transfer agreement. It may be a structured path to an acquisition and everything in between. So by creating those options, which may or may not be exercised, we see that as the success point for us.